Folks, welcome. It's Earl, the Money Coach, and we want to talk about today the five major kind of life insurances. Most people are only aware of two. You have your term life insurance and your permanent life insurance, but they're not aware of the five major, which is your whole life insurance, your term insurance, your universal life insurance, your variable universal life insurance, and then your index universal life insurance. So let me break down all five. Number one, you have whole life. Most of you guys know what that is. Whole life insurance is good for your whole life, all the way up to age 121 for the majority of whole life insurances out there. You're going to have a fixed amount. So if it's $200 a month today, it's going to be $200 a month when you're 65, 66 years old and beyond, when you have your whole life. Now, for whole life strategies, guess what? All that money inside of it, we call that cash accumulation. Now, cash accumulation is what gets to grow tax free. They have something called a Section 7702 for these life insurances that allow the cash value inside a life insurance to be able to grow tax free. So, whole life is a great strategy, but as most people know, whole life is very expensive. So you're normally paying a lot more. A $200 policy may cost $15 when you look at the face amount and face value on a term policy. Okay, now also remember, when you're taking out money from a whole life or any kind of permanent insurance, you have what they call a loan provision. Now, what's a loan provision? That is the amount that they're going to actually take out when you want to withdraw your money. So let's say there's a 5% loan provision, a 7% loan provision. You want to take out $10,000, you're going to have to pay that 7% loan provision or that 5%, whatever your company has. Great strategy. But as we know, whole life is expensive. So what happened? People said, look, I don't want to pay that much. That's where your term life insurance is coming to play. Now, term life insurance is exactly what it sounds like. It's for a duration of time. From 5 years all the way up to 30 years is the general speaking. Some companies may have a 35-year term. Other companies may have what they call a term 65, meaning it's good in its entirety all the way to 65 years old. So if you're 18 and you get a term 65, you technically have a 47-year term life insurance policy. Great strategy, very affordable, but remember this, 98% of term life insurances do not pay out. 98% of term life insurances do not pay out for the simple fact is most people outlive them. I got my first term life insurance when I was 25 years old. So by the time I'm 55, that policy is going to be gone. And then when you want to renew that policy at an older age, guess what? That premium is going to go up a lot more. But term life insurances, they do what they're function to do. They're taking care of that duration of time frame. And I always say you use term life insurance to get to retirement, but you use your permanent life insurance to get you through retirement because you could withdraw money. So your term policies are great to have, but a lot of people say, look, a whole life costs too much. Term policies expire, and if you want to renew, then it's going to cost way too much to get a whole life for my permanent. That's where universal life insurance came out. Now, universal life insurance is in the middle between your term and your permanent, your whole life. So what it means is it costs a little bit more than your term insurance, but it's normally a little bit less than your whole life insurance. But what is the drawbacks? Think if a whole life you could get a 3% or a 5% average, universal life, since you're paying more, that actual average most likely is going to be less. So what that means is with your universal life strategy, guess what? You may have a 1 to 2% gain or 1 or 2% interest instead of having 3, 4, 5, 6% in your regular whole life. So it does cost, it's more affordable, but your growth is actually going to be a little bit less and your loan provision isn't going to be as much. So as you see through time, people are like, look, all right, so we got something that's universal, could be used universally throughout my life. It's not as expensive as whole life, but I'm not getting the gain of whole life. So what do I do next? That's where variable universal life came into play. Now, variable universal life is the only life insurance that's technically attached to the market. So if the market goes up 20%, your variable universal life goes up 20%. But if the market drops 20%, your variable universal life is going to lose 20%. So you get the high risk, but you also have the high rewards. So as you see through time, Universal life insurance, variable universal life insurance, they kind of started evolving from the whole life, which comes to the last life insurance that most people know about is the IUL, the index universal life. So how did that get structured? They pretty much took all the pros from the other four life insurances, your whole life, your term, your universal life, your variable universal, got all the pros and eliminated all the cons. So with your index universal life, it's still a little bit more affordable than your whole life, but guess what? Now you have a cap and you also have a floor. Most of the time, the floor is zero. Zero is your hero, meaning if the market drops down 20%, you didn't lose anything. But if the market goes up 20%, you may not have all that growth. You might have a ceiling on your rooftop, meaning you might get 15% if the market does 20, 13%, whatever the case may be. So you might not get all the gains, but you get none of the losses. But also what's great with the index universal life is the loan provisions is normally, generally speaking, more affordable than your whole life's loan provisions, normally around 2%, 2.5% over the course of 10 years. And then generally speaking, after 10 years, it gets dropped down because the companies are crediting you back what you could get. So this is kind of the history of life insurance. All of them are used for different things. Some people say term is horrible. Look, you have a 30-year mortgage, get a 30-year term to take care of everything. Some people say permanents are horrible. Look, if you want to have cash value, you could use your permanent insurances. But remember, life insurance is not an investment. Okay, life insurance is pretty much a supercharged saving strategy, meaning you get the reflection of the market, but it's not in the market, so you don't participate in all the actual losses. So if you're expecting to double your money in a year or two, that's not the case of whole life insurances and permanent insurances. You're looking for long, steady growth over a time span of 15, 20 years to get to what you're looking for. But the best thing about all of this is it gets to grow tax-free. All that cash accumulation is getting to grow tax-free, which brings the last thing I'm going to touch on, the cost. A lot of people say, Earl, cost of insurance is going to cost a lot. There's a lot of fees in my life insurances, which is correct if you do not have some of these strategies structured correctly. If structured correctly, a lot of times you could eliminate a lot of that cost of insurance within the first 3 to 4 years. But if you're just putting in a target, you're just putting in a minimum, it may take you 10, 15 years to go through that cost of insurance. But is that cost of insurance going to be as much as what you're paying taxes on your 401k, taxes on your IRA, capital gains taxes? You have to look at all these things and how it could actually be affecting yourself. So I'm not saying permanent insurances is the best retirement strategy, but it's a great retirement strategy to put within your portfolio. That way you get supplemental income. So if you guys want anything more, follow me, like, subscribe, and I'll be giving you all the tips on your insurances. This is Earl the Money Coach, and I'll see you at